So I have this timer that I actually have to start like 5 minutes early, and if I don't start it on time, then it decides that it's gonna take longer. So anyway, today we are going to be talking about position sizing. And before I actually do that, we'll take a quick look. We're just going to talk about the market really quick because there's a couple things, interesting things to talk about. So in previous live streams, we looked at SPX, and we drew this expanding channel, and we looked at kind of some of these boundaries. And it's kind of been fun to follow it, right? So we decided at that point right there, that little let's find a little circle here, at this little point right here, that we were going to say, okay, well, what's going to happen right there? Like, either we're going to bounce off that thing and potentially move back down towards those moving averages, or we're gonna keep going up. And we've kept going up, and it's been crazy, right? We're like at all-time highs again, which of course the market moves up and to the right generally anyway. So it's not surprising that we would see all-time highs as time goes on in each of the indices. But this is it's kind of interesting because we still have Iran war stuff going on that has not gone away. It got really tense early in the week, and it investors seem to not be caring so much. We've got really good earnings across the board. In fact, probably a good reason why we're seeing these all-time highs isn't because of most of the stock. It's probably because we're being propped up by some of the massive, companies. And in fact, if we take a look at the heat map, I like doing these. I like looking at the heat maps. So this is performance for the week. This is like, a lot of people look at heat maps, and they'll choose percent change for the day or the hour or whatever. This is a weekly heat map, the same one I put in the blueprint. And as you can see, we have more red. We have some green stuff, but we've got a bunch of red stuff, and this has kind of been the way that it's been recently. And so we are kind of being propped up by a few companies, and there's also some discussion or some question about, well, are they cooking the books? Are they actually making as much money as they say they are? So I don't know. Maybe they are, maybe they aren't. Who knows? Who knows? One big mover that I like looking at, and I'll just talk about it real briefly here, is Rocket Lab. Rocket Lab has been killing it. And in fact, if we look at on the 1 hour candle, we go to the earnings right here. Since earnings, Rocket Lab is up 70%. 70%. This stock has risen in this week after earnings. So it's at 132.55. I think I was trading with it. I have a $78 put on it that expires tomorrow, that or a set of puts that was before this week was could have been, it was right around there. So it has just been outrageous, the growth that we've seen in Rocket Lab. So that's a cool one. I'm not sure I'll invest in it at this point. It might be overvalued, but anyway, on to the topic. So we're going to talk about today, the topic is position sizing. Now, I will tell you guys that for me, there's a lot of details in position sizing. And so I was sitting down the other night, and I was thinking okay, well, what am I going to talk about? What am I going to mention? How am I going to structure it and organize it? So I sat down and I wrote out all these notes. And so I've done a lot of public speaking over the years and stuff, and I'm not one to do a bunch of notes and stuff, but I don't make note cards. I think that's, you either know your shit or you don't. But I did this because I wanted to go over some really specific details. So position sizing. So we talk about position sizing. I think everybody probably knows what position sizing is. If you don't know, this is the amount of your money that you invest relative to your total size of your account, right? And you can talk about position sizing in terms of percentage of your total cash. You can talk about percentage compared to, you know, other stocks that you own, right? You can buy them in tranches, right, of that position size, but that's what it is. That's position size, and position size is a big deal because if your position size is 100% of your account, then you're putting everything on the line, like, right, you're putting all your eggs in one basket, so to speak. And if your position size is like just above zero, the smallest position size that you can make, then, you know, you're not making anything. Like, you don't have enough on the line to make any kind of profit that makes it worth the risk. So when we talk about how to decide what position size to go with, we have to talk about risk, because some people are like, well, you should do 1% to 2%. And some people are like, you should do 5% to 10%. And some people are like, well, you should do a quarter of your money or whatever. And very few people, I think, would say that you should do more than 50% on a particular equity. But what it really boils down to is your own personal risk. And I kind of refer to this as the risk equation. And so if you imagine yourself sitting in a college class or a high school class, and, you know, the professor's up front and they're like, okay, class, like, you know, what, like, let's say you're in a chemistry class and the professor's like, okay, like, can anyone give me an example of an exothermic reaction versus an endothermic reaction? And then everybody raises their hand and they're like, oh, well, you know, free, like, air conditioning, and, oh, well, like, you know, when you do this and you do that and all these, you know, and you're brainstorming, right? And so that's what I did here with this risk equation, because when most people talk about risk, they're like, in fact, I think you could even Google, like, what is risk in the stock market? And it'll, like, probably Gemini will pop out like a specific equation with like 2 or 3 things, and like, oh, your position size times your, like, whatever times this, and that's your risk. But at the end of the day, like, come on, like, it's a whole lot more complicated than that. And so I kind of sat down and I did this thing and I brainstormed a little bit and I said, well, what's risk anyway, right? Okay, so position size is part of the equation of risk. The more you put into a stock, the more risk you have. And in that sense, right, like, just investing in the stock market is a risk, right? If you're investing in the market, then you have a risk, right? Even though it might be infinitesimal that a stock or a company goes out of business, it's a non-zero risk, however small. So how much position you put in is a risk. How much cash is already tied up? So if you have 75% of your cash already tied up, that's a risk by itself, right? The strike price is a risk. The strike price is probably the biggest in-your-face risk that we see on a normal basis, right? If you're writing an option and the strike price is at the money, well, there's a whole lot larger of a risk of assignment than if it's, 10% or 20% out of the money, right? This is part of risk. The length of contract is a risk. If you write for, 6 weeks out, well, 6 weeks is a really long time for something to happen, right? Good things can happen and bad things can happen too. And six weeks gives the market lots and lots of days for something bad to happen. So that's risk. Psychological fortitude is risk. When people get nervous, right, they make bad trades. When you stress out, when you look at stuff, you've got FOMO and you've got revenge trading and you've got, all of these different types of things. Sometimes people close stock. I talk to a lot of people all the time that close options at a loss because they're worried about the stock going too far down, even though they're not actually worried about the company going out of business. There is a psychological element there. So that's psychological fortitude. It's a risk. Strategy type, right? If you're writing naked calls, that's super risky versus covered or secured. Straight puts or straight calls, for that matter, are more risky than certain types of spreads, right? Which cap the losses in certain cases. Account goals are risks. If you're trading versus investing, right? An IRA account versus a brokerage account. And in fact, you hear this all the time, like when you're young, you should take risk, and when you're older, you should be more conservative, right? And so how you do this, right? Like people who are, day trading are taking, especially if they're following rules where they sell by the end of the day, regardless of where they're at. There's big risk there compared to writing a leaps contract on a stock. Volatility is a risk, right? The sector that you choose to write out of. I like tech stocks. They tend to be more risky. Rocket Lab is 10 times more risky than investing in Coca-Cola. Coca-Cola is like super, kind of normal, and it's just this big dinosaur, and it doesn't move much. Ford is the perfect example. Ford is like the perfect beginner's option to write on. So the fundamentals, the size of the company, all of these things, these are risk. The indicators are risk. Upcoming events are risk, right? Elections, we always hear about elections. We see different types of volatility when the Fed's about to make a decision, when earnings are on huge risk when earnings are coming, right? And then I write, what else? You could brainstorm this. You could come up with other things that are risk that vary, right? That change this whole equation. And I promise, I know I went off on this for 5 minutes. I promise there's a reason why these things are all there, and I'll talk about it a little bit when we start talking about how to size. But there's also one other detail, and that is that there's no such thing as no risk. There's a no risk interest rate, right? You can throw your money in your money market account. That's the no risk interest rate that they use in the Black-Scholes equation, or maybe they use T-bills, but it's whatever. It's all the same. Sitting on the sidelines with your money is its own risk. And whether inflation is high or low at the time that, at the current moment, your money is shrinking away. You sit on the sidelines, that is its own set of risk. There is no way getting out of risk. That's life. So you just figure out where your risk level is, and it's never zero. So, okay, so let's talk about how to, and you could, people should go out and think about themselves. Well, what else is risk, right? Like, what things matter to you? So how to size. This is kind of like a basic idea of how I think that people should go about sizing, because I don't think that you should just say, oh, well, this guy or this company said to size at 5%, so that's what I'm going to do. I mean, it's not a bad place to start. You have to start somewhere, but you shouldn't be just, blindly doing this, right? So, okay, so start with a percent of your account that you're willing to trade, right? So, and this doesn't take into account yet any of those other types of risk, because you might say, well, I'm willing to trade 100% of my account, but I'm only willing to do that with super conservative strike prices or super short contracts, or I'm only doing it because I have a mental coach and I'm working on this thing, right? Or I'm only doing it because if the analysis is whatever, right? So right off the bat, you're going to say, okay, well, if you want to trade 100%, then that's okay. If you want to trade just 1%, then that's okay too. But then ask these questions, right? What is it worth considering keeping a small cash position, right? Because the cash position is still making money, right? It's still, 3.4, 3.2% or something right now. So in terms of diversity, right? Like just trading, say 90% of your account and keeping a 10% cash position, well, it's at least some diversity. If you only want to trade 1%, well, then maybe the question to ask is, okay, is that enough money? Like, is it enough money to buy or sell an option contract, 100 shares? Is it enough to trade, 5 or 10 shares of the stock you want to trade if you're not writing options? So you consider that, and then you push those numbers in, right? Like, maybe from that you're near 100%, and maybe that question, you think about it and you're like, okay, well, maybe 90% is more reasonable, or if you're at 1%, then maybe 10% is more reasonable, right? So you start with that, and then you can divide that number by the number of positions you're willing to hold, right? And holding more positions itself is kind of a risk, right? Regardless of your position size, because you have more things that you have to worry about, right? You have more stuff. Yes, you're diversified and that's good, but you also have more stuff you've got to keep track of. So you divide that number of positions by which you're willing to hold, right? So if you're willing to hold 10 positions in your account and you're using 50% of the account balance, then each position is 5%, 5% of the account balance, right? So that's the simple piece of it, right? Like that's the simple calculation there that you can use to come to a position size. Is you just need to know how much of your total account you're going to trade, and you just need to know how many total positions you're going to take. One position, probably it's not, not diverse enough, right? Like unless your one position is because you're like, well, I'm only going to trade 2% of my account. Well, probably you can only have one position anyway, right? Which is fine. It's fine. I chuckle a little bit, but like, it's fine. Like if that, I have a friend and he's super conservative and he will not put money in the stock market and he won't put money into like basically anything doesn't have super incredible insurance, because, and even then he's kind of like, well, maybe I should take all my money and throw it in a suitcase in my closet because, if insurance can only do so much, right? And what if a bank collapses and FDIC runs out of money or something? Like, what are they going to do? So like, there's always risk. But the point is that if you're looking at your positions here and you say, okay, one position is not enough money not enough positions to be able to have a diverse background, for diverse portfolio. 20 positions gets super difficult to manage. I don't ever have 20 positions myself. I always seem to have more than one position. And when I say position here, I don't necessarily mean that I own that thing. I almost always own something, but what I mean is a contract that you've written or a stock that you own, right? It doesn't have to be just a stock that you own. But 20 positions is a lot. Like that's, unless your strategy, right? And this is where we come back to that risk equation, because we've got the strategy types, right? Unless your strategy is to write one leaps per month for 12 months, then that's 12 positions. And that's not terribly bad to deal with. It's also a lot less than 20. So that's the thing, is you just have to kind of figure out like how many positions am I comfortable holding when we have this position size. And so here's where we start kind of getting to tailor it a little bit more. And the note is, if you're stressed, incrementally reduce by 5%. So that's the piece where we get in here and we say, okay, well, let's say that we put out 100%. We have a position size of 100%, and we've looked at all the other things in the risk equation, and we've actually written a trade at 100%. Well, if you're stressed out from that, if that's something that bothers you, if you're chewing your nails checking on the stock prices, if it goes down and you get concerned, or you can't sleep at night or whatever, then reduce by 5%, just 5%, and then make another trade the next week. And if you're still stressed, reduce by another 5%. And if you're, stressed past that, another 5%, until you start feeling comfortable about it. Because like that's the biggest marker in all of this. The biggest measurement, the biggest metric is, how do you feel about it? Like, you can talk about strategy and, analysis and all these things all day long, but if you don't feel good about the trade you're making, then there's something that you should change so that you can live without that stress. On the flip side, if your premiums are really small, you're not feeling emotionally vested, then increment by 5%. So if you're in at a 5% position size, right, or let's say 5% of your account, right, just to make the numbers easy, and it's 100% of that, so it's a 5% position, then, if you don't feel, if you don't even care, or if the premiums are so small that you know, you're not making any money, or you're making less than the risk-free interest rate by doing that, then add 5%. Add 5% each week and then make a trade. Add 5% to that, and then see where you end up. So that's one way you can start varying. You can start locking into a size once you've kind of come up with a ballpark, right? And then you can vary details about the position size, right? It says go from 5% to 10% per position by going farther out of the money and or investing in a less volatile sector. What do I mean? The risk equation here is a whole bunch of variables, right? And so if you take one variable and you relax it and you make that variable less stressful, then you could take another variable and make it a little bit more stressful, right? And the equation still balances to the same, I don't know, value, you can call it, right? So that's the thing is if you want to increase your position size, or if you want to decrease your position size, then change some of those other variables, right? If you want to go from 5% to 10% on your position so that you can actually make decent premium, well, then you've got to change something else, right? You might have to change the sector, right? You might have to go to a tech stock, right? Or you might have to do a much better technical analysis so that you feel comfortable putting that money in, right? Or you change the length of the contract. So you can vary all these, and that's, at the end of the day, that's why this risk equation the idea of it is so important, because you've got all kinds of things that you can tune. Like you can tune all of this stuff. You can tune all of the strategy types and the account type that you're using, and you can work around events, and you can try to keep a much closer cash position, right? And so those are the sort of things that you want to really, latch on to there. And I would say that you also want to try to tune that by looking at market dynamics, right? Like if you have a position size that you feel comfortable with and the market turns bearish, maybe you should drop that position size a little bit. If you have a certain position size and you end up having a bunch of put assignments assigned to you, and you're at a much lower cash value, then maybe reduce your position size, right, until you can get rid of some of those other stocks. So these are some details about how I think about position size, even though I'm using words like risk equation and there's a little bit of division and stuff in here. Like it's not that complicated, right? Like it's not complicated. It's simple, but it's not easy. And that differentiation there is important, right? It's simple, but it's not easy, because we're talking about emotion here. We're talking about something that has no right answer. So you have to go through this for yourself, and you kind of have to answer these questions. And I can kind of help people answer these questions. I can put them out in such a way that it makes it easy for you to just say yes or no or these sorts of things, and then go through this path. But that's what makes it difficult, is that it's not just a simple thing. It's not just like not just an easy thing, right? It's not just plugging in a number and coming out with a position. Like there's a lot of impactful psychological and emotional stuff at play here. And like I wrote at the bottom, risk equation is unique to each and every person. Everybody's got different details, and that's not just risk, right? That's everything about trading. That's how you do your analysis and how you approach strategy, and how you prefer to the timeline that you like to write options or trade or whatever. Do you scalp or do you invest, right? So these are totally different things for everybody, and we're never going to be able to identify them perfectly. You're never ever going to be able to look at them, write them down, and be exact about it. It's too visceral. It's too visceral for that. And I think it's important to be in touch with that so that you can control it in a stressful environment. I do think that working at it and tuning it allows you to find a risk size that makes sense for you based on all of those factors. A position size that works well for you. So those are just some thoughts. I did this particular live stream because I've actually had two conversations in the last week with GTH members about it, and I thought, it might be good to talk about it. So hopefully, hopefully it's useful. Hopefully it was worth taking a few moments away this week from doing like an analysis or, you know, setting up some kind of trade or something, because it is a big deal. And if you have the wrong position size, then and it's way too small, then maybe you get frustrated because you never make any money with trading and you quit. And if you have a position size that's too big, and we have, I don't know, people love to talk about black swan events. What if there's a black swan event? Well, if something like that does happen, and you lose, you get burned badly, then that's even worse. So I do think it's worth taking the time to talk about. I hope that it's useful. I know I like ramble and repeat myself a number of times. So if anybody has any questions about it, feel free to reach out. You can comment on the video. And of course, if you like hearing all this stuff, I would certainly appreciate a subscribe or a share, especially as I'm trying to grow this little channel here outside of the Patreon. So anyway, hope everybody enjoyed. Have a good rest of the week, and we'll talk to you guys soon. Take care.